think you also are seeing, a shift basically from paper assets to hard assets. And I think that that's going to continue, whether it ends up being inflation or deflation in the near term. I think that a lot of that is just a function of this global shift away from the dollar.
Thanks for joining us for part 2 of our interview with dueling macro analysts Grant Williams and Stephanie Pomboy. If you haven't yet watched part 1 of our discussion with Grant and Stephanie, in which they debate what lies ahead for today's uncertain economy and distorted financial markets, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Grant, Stephanie, and our partners at New Harbor Financial share in this video. Oh, but if you haven't yet, don't forget to subscribe to this channel by clicking on the red subscribe button below, as well as that little bell icon right next to it. And now, here's part 2 of our interview with Grant Williams and Stephanie Pomboy. Well, let's tie it all together now. So big, existential risks out there, and the guys with their hands on the tiller, we don't have any confidence in. We've heard Magoo's farcical. Stephanie, I think you probably would have chosen a different F word if this weren't a family-friendly conference. But the folks that are watching this are asking themselves, all right, great. Grant and Stephanie, very smart people. I agree with them. I don't want to become collateral damage when this whole thing falls apart. So what strategies/tactics would you encourage today's prudent investor who wants to preserve capital foremost, but ideally wants to prudently grow it, but just in a risk appropriate way going forward? What are some of the asset classes, the sectors, et cetera, that you are identifying as either good places to be now or good places to be later after some sort of correction? Grant, why don't we start with you?
Well, I think I've spoken a lot about this recently, Adam, and I think it's incredibly important. What we started this discussion was with this debate about inflation, deflation, because right there is the most important decision that you have to make for your portfolio, because depending on what you think is the likely future, and it's important to understand what everybody's time horizon is here. You're going to have a very different portfolio if you believe that we remain in a deflationary situation, and that's going to be the problem. Then the tweaks to your portfolio, which has been working in a deflation environment, will be fairly minor. The same things will work. Now you're going to reach the limit in a lot of bonds. You're going to have to get a lot more picky about the kind of bonds you want exposure to. But the status quo will continue, although it may be a bit rocky. If, however, you ultimately come down on the side of inflation, and again, I want to hammer home this idea of time horizon. I think any decision you're making over the next matter of months is a coin toss, frankly. I think you could make the case either way, and you have to be very nimble. But if you're looking to invest for the next 5 years, and you come down the side of inflation, as I have, then I think you have to look at what's going on around us. We are seeing, if we are seeing a shift from deflation to inflation, then there are a lot of things that necessarily follow along with that. We're already seeing some of them. We're starting to see a rotation out of growth into value, for example, which is clearly happening, and that, I suspect, is so-called smart money trying to get ahead of the inflation trade. And that means a rotation into real things, into commodities. We're seeing the headlines about commodity prices rising, but the companies that produce them haven't gone crazy yet. You can still buy companies that produce things that are classic value plays relatively cheaply, because they just have not been a place to be. And Steph and I have spoken about this in the gold mining space for the longest time, and it's a very easy place to come down to, and probably a fairly predictable one. But what I would say is that over the last couple of decades, and again, this is something that I've banged the table about in recent weeks, the gold mining companies have been forced to get their balance sheets in order, to get their businesses in order. They've made great strides in that, and as I said numerous times, there is no better value investment than a company that literally pulls money out of the ground, which is what the gold mining companies do. And when Steph and I last spoke about this, she made the fantastic point that whilst this space is not big enough to attract serious investment dollars, the better these companies do, the bigger and more investable they come, and that is going to suck in a lot more capital. And when you compare the mining companies to other sectors, it's tiny. But these companies are producing record free cash flow. Their results have been across the board strong, some of them excellent. You are absolutely hostage to fortune of the kind of vagaries of mining, which you get mine shutdowns here and government intervention here and there. But if you pick the right companies in the right jurisdictions, then you're going to do fine. But the one thing I would say, and perhaps the most important shift from the old paradigm to whatever the new paradigm looks like, is the return of active management over passive management. I think it's been okay to be passive and to put money in passive funds and allow them to do what they do. If we do get a secular change of any kind and these rotations that I've just spoken about happen, the biggest one is arguably going to be away from passive and into active. And I think, again, we're starting to see that. I'm starting to talk to active fund managers who are seeing decent inflows for the first time in a long time. So I think that the best advice I can give everybody is to do a proper assessment of your portfolio, understand how you're invested, understand what you're invested for, the kind of outcome that you will be successful under, and then check your timeline and think to yourself, okay, if I'm invested for a deflationary outcome and my time horizon is 5 years, am I set up effectively? I would argue that you're probably not. And if that's the case, you need to think very carefully about these secular shifts that all come along with a change from deflation to inflation.
All right, very, very well said. Stephanie, reaction to Grant's list and given your, I believe, don't put words in your mouth, but your sense that deflation may be more in the driver's seat over the next 5 years than at least Grant's estimation, would your allocations differ any differently?
Well, I guess I am a proponent of the deflation before inflation thesis. So, I do see this blip in inflation being contained to the input price side right now. And ultimately, I guess in my scenario, the profit margin squeeze will precipitate a correction in stocks, which will feed the deflationary pressures, just like every bubble burst in the past. That will be followed by a massive response, which will ultimately bring about the real hyperinflation. So again, there are a lot of moving parts and I could be wrong in every single one of those. But the one thing I would say is that regardless of whether you think it's deflation or inflation, gold is appealing and a lot of commodities are appealing in that regard, just because they're a hedge against what we're going to see in terms of the policy response. But I'm very bullish. Obviously, I'm bullish on gold from the standpoint of all the things we've already talked about with the fiscal and monetary policy, et cetera, and the silent debasement of the dollar. But I think you also are seeing, a shift basically from paper assets to hard assets. And I think that that's going to continue, whether it ends up being inflation or deflation in the near term. I think that a lot of that is just a function of this global shift away from the dollar. And so I don't see any reason for the input price pressures to really recede. I mean, for sure, if we're at a interim peak in global economic activity as the economies have reopened and we start to, take a little breather, sure, you'll get, pullbacks here and there. But in the long-term sweep of things, I think commodity prices are going to continue to move higher, particularly the strategic resources, which would be oil, gold, anything you can stockpile, agriculture, obviously. So I definitely would be trying to position and continued bull market, I'll call it, in that space. And then I guess because I'm so concerned about what's going to happen with the outlook of the dollar, I'd really be looking maybe to add some non-dollar exposure if you're a U.S. investor and the no-brainer to me would be to get long resource economies, that are going to benefit because they're producing all of these commodities and stuffs that everyone is now starting to stockpile. So that's another potential avenue to put some money to work. But I guess, for people who are sitting here and the bulk of their investments are in the US stock market, I would definitely try to be as defensively postured as possible. And as Grant mentioned, looking for companies that really have exposure to basic resources, and avoid those that are levered bets on a continuation of this crazy status quo that we've had brewing here. I'll resist the impulse to, go on a rant about Tesla and that kind of stuff. But, there are some obvious stocks that I wouldn't have in my personal portfolio. And then I guess the question is, where do you put, do you want to have money in cash? And, my feeling is it really, I feel comfortable having a fair amount of cash just because I feel like if and when that market correction happens, I'll have powder dry with which to swoop in and take advantage of some real opportunities. But that's because I think that is going to happen sooner rather than later. If it's 5 years down the road, you're sitting in cash and it's being eroded every day by this endless debauchery by the Fed. So I'll leave that to your listeners and viewers to decide, how close they think any kind of reckoning would be. But generally, I'm positioning away from paper assets into hard assets and stockpiling spam and peanut butter.
Yeah, Adam, I just add to that if I can, because if you look at the chart of real assets versus financial assets, you'll see how extreme we are. There's a long way for that reversal to go if Steph's right, which I think she is. But the other point I would make is I keep talking about time horizons, and Steph just made the case beautifully there. She laid out a very credible path, which I can absolutely see playing out. And if you're investing for the very short term, then you absolutely need to be wary of this deflationary impulse. But I think the point Steph made is the crucial one to understand. Even if you get that deflationary impulse, the response is going to be massive, because it will have to be massive to try and overwhelm it, and that ultimately will lead to inflation. So if you're trying to invest with any kind of medium to long-term time horizon, this is why I believe that inflation is the thing that you have to fear, because I think Steph laid out a very, very credible flight path there, and it's terrifying in the short term, but in the long term, if you have the ability to look through that and use that time to position yourself, it could be a very useful period for you to get yourself set for an inflation turn.
We really do agree.
Yeah, I was going to say, thank you for that clarification, because it seems like both of you see similarly on that, and you haven't seen David Hunter's presentation at this conference yet, but he sees the world very, very similarly as you guys. And it even goes back to the Kapoom theory, which I've sort of written about for years, which I stole from Eric Jansen. But it is this deflationary crunch, which is it's almost like a depth charge, which implodes and then explodes, right? So you have this deflationary crunch, and then the policy response is just this explosion that's highly, highly inflationary. So thank you guys for being so specific. This is exactly the kind of fodder that the folks watching this video are really looking for, to be able to try to make sense of how they want to position for all this. And if I can just recap real quickly, just so you guys can say whether I took good notes or not. Grant, I think you started wisely with saying, look, you got to decide what you're solving for, right? Inflation or deflation, what's your time horizon? But the trends that you see going forward are rotation into value, basically away from growth. And that's really going to benefit real things and the companies that produce them. And also, I agree with you on this. It's going to get a lot harder to separate the wheat from the chaff. You can't just sort of count on the tide rising all boats. And so active management is going to come back into vogue because it's going to be necessary. Stephanie, it sounds like you see the world fairly similarly to Grant.
You can summarize me as what he said, just not as articulately.
No. I think you really raised you raised the part about the wisdom of holding dry powder on hand for a potentially big market downdraft. And I'm going to call this sort of the blood in the streets opportunity, right? Which is that you're going to be able to get into today's assets at much lower valuations if you're nimble, right before the policy response just sends the prices of everything, but particularly these well-positioned companies, to the moon, right? So it's one of those things that doesn't come along very often in an investor's lifetime. And if you can, prudently position for this and have the courage to act when the time is right, there may be some real opportunities here, not just to protect your capital beforehand, but to create very outsized upside returns. The only thing I want, and you also brought in the global shift away from the dollar, though, which is kind of sit on them in the short term, but in the long term, look for ways to reduce your exposure to the dollar as the world is trying to figure out how to become less dependent on it. The only thing I want to add to you guys is I interviewed Rick Rule recently, who you probably both know. He's a very seasoned natural resource investor, thinks very similarly to you guys. But Rick's a boots on the ground kind of guy who knows what's coming out of the earth. He knows the companies that are, extracting, drilling, mining these commodities. And he says, even if demand doesn't change for the next 5 years, he sees severe supply shortages ahead because of lack of investment in the pipeline over the past couple of decades. So that's just another really important factor that adds onto your guys' compelling thesis already. All right, so guys, with that, I want to thank you so much. I could literally talk all day long with you guys on this. Someday we should do a conference that's just you two talking for the entire day. But I really appreciate you guys taking the time. That might sound like a nightmare to you guys, but it would be a fantasy to everybody else.
Hey, we do it all the time.
Well, thank you so much, Grant. I know that you're joining from outside the US. Stephanie, I know it's later your time. I thank you so much for joining our conference. And for people who have been thrilled by your commentary and would like to follow you and your work, where should they go? Steph, let's start with you.
They can visit macromavens.com, or they could follow me on Twitter for the occasional, very rare,
you could do it.
snide comment at Pomboy.
You got
it. Did I get it?
You got it. You nailed it that time.
Oh my God.
I'm proud of you.
I basically retweet whatever Grant puts out.
I kind of do too, just to be honest.
He's gold.
Gold, I tell you.
Yeah.
For me, listen, it's simple. Grant-williams.com. You'll find everything I do there, including the super terrific happy hour with Steph. And if you want to buy the latest CD from the Big Magoos, then we've got a concert tour coming up next year. Then go to thebigmagoos.com.
Awesome. I want to buy front row seats, so make sure.
All right,
there
you go. I'm here talking as we do
All
every
right, guys.
week.
Well, thanks so much.
Partners
And
of New
really
Harbor
look forward to talking to
Financial.
you guys later
That's
this
Mike
year
Preston
as,
and John
developments start
Llodra.
happening.
Hi, Mike and John. How are you guys?
Get your guys' real-time insights then. Thanks so much again.
Hello, Adam.
Pleasure.
Good
Thanks,
to see you
Adam.
again.
See you, Steph.
Good.
See ya.
All right, guys. I'm
Cheerio.
going to start that over and just sort of go straight in.
Okay.
I've learned there's a bit of a dip when we do the transition, so I want to try to keep it as quick as possible. All right, 3, 2, 1. All right, and as we do every week, I am joined by the lead partners of New Harbor Financial, the financial advisory firm officially endorsed by Wealthion. Mike and John, can't wait to see your guys' reaction to what Grant and Stephanie said. Just a quick dial through before I hand you guys the football. Grant said, look, you got to pick your timeline. You got to determine over that timeline whether you think inflation or deflation is more likely and bet accordingly. He thinks inflation is going to win out. He said he sees a rotation from growth into value. He really likes hard assets and the companies that produce them. Particularly, he loves the gold miners. He said that, they're pulling money out of the ground. It's a great space to be in this type of environment. He thinks that this space is poised for massive capital inflows going forward. And he underscored that we're entering an era where active investing is going to come back into vogue because it's going to have to. The winning passive strategy, just buy an index and let it ride over the past decade or two, he explained why he thinks that's coming to an end. Obviously, I think managed advisors like you guys, probably that's music to your ears. Stephanie complimented a lot of what Grant said, even though she's more of a deflationist. She likes hard assets. She did underscore she sees the de-dollarization trend globally continuing to accelerate from here. And she recommended that folks get exposure to non-US resource-based markets. And I think emerging markets type of funds are probably some of the types of investments that she was talking about there. She also said that cash is a good thing to be holding going into a time where she expects a large market correction. Sounds like Grant shared that opinion, as have previous guests on this program, like David Hunter, who predicts a really big one, like almost 80%. I think Stephanie sees a similar size drop like that because she is planning for a blood in the streets moment. Anyways, guys, listening through all those, I want to hear your reactions, but they sound to me very, very complimentary to what you guys have been talking about in this program for years now. John, let's start with you.
Yeah, Adam. Well, first of all, it's great to see two very thorough and bright minds together in one forum. They I think covered a lot of ground together and tried not to agree on a lot of things, but their takeaways I think were remarkably similar in terms of where we are in the cycle. Deflation, inflation. I think Grant's comments there about pick your time frame. We here like to think about inflation, deflation as a tug of war, and any good tug of war, it's not clear who the victor is in any given short period of time. In fact, it might seem like one team is about to pull the other into the mud pit in the middle, and guess what? One slip foot, and the other team gains. And I think we're still in that phase. It's not clear that the winner is anointed yet. And that's why the way we've positioned it kind of can have it both ways. We're holding some types of things for clients that do very well in a deflationary type episode, things like cash and some long-term bonds. Inflation scenarios, we're holding commodities, precious metals, precious metal mining, energy stocks, emerging markets. So I guess the first ingredient that we like to inject here is that we need to be humble and know that we can't with precision navigate the binary choice of inflation deflation, because there's lots of reasons to think about both being possible. And in fact, I think Stephanie kind of promulgated what we like to think as a kapoom scenario, where there's maybe a deflationary kind of depressionary type thing, deep recession, followed by an even more massive response by policymakers, which creates a supernova of inflation. So, yeah, I mean, we kind of agree with most of what both of them said, and you almost can't disagree or have to pick sides between the two of them, frankly.
All right, yeah, and as I think through how the New Harbor portfolio is positioned, as you've all shared with us, you've got the cash, as you mentioned. You've got the precious metals exposure to the metals themselves and the mining producers, which is good for the inflationary side of things. You also have exposure to emerging markets and to some other hard assets like energy, oil, et cetera. So it was interesting as they were sort of ticking off all of their recommendations. It sort of felt like they were just going through the New Harbor menu there. Mike, I'm curious if you've got anything to add to John, and then I'd love to get your reaction to last week's results from the Fed meeting, which stocks seem to have shrugged that off, but certainly kind of kneecapped the precious metals the day after.
Yeah, Adam, thanks. I don't really have much to add to what John said. I think that it's I enjoyed the presentations as well, and I do think that our viewpoints are very close and parallel to what we saw there, as is our portfolio management. Last week's Fed decision, Fed came out and said, well, you know what, we think that we're going to raise rates, or we might raise rates in 2023, 2 years out, and maybe by a quarter basis point or so. Immediately, the stock market sold off on that news. Then immediately knee-jerk came back, ended down the day a little bit. The stock markets, though, still remain near their all-time highs. Gold sold off pretty immediately on that news, and which is kind of curious that the dollar took off, yields went down, bond yields went down, and gold got hurt. You'd think that if rates were going to be increased, that rates would have went up and bonds would have went down, but that's not how the market works. The market basically sold the news in terms of bond yields, sold the news in terms of gold prices. Gold was down close to $100 following the rate decision. Overall, we don't really think it's much of a factor in anything, though. I mean, the Fed is just dilly-dallying. They're playing around with their dot plot, saying we might do this, we might do that. I think that we all know they probably won't do anything. You know, they say they're going to raise rates maybe in 2 years, but I think we know full well that if there's any stumble or any drop in the market whatsoever, they won't raise rates. In fact, they're probably going to reduce rates, I would think, given the fact that the stock market itself is showing some, you know, bad internals, some signs of excess and excess of euphoria. Stock markets, you know, the valuations have never been higher. It's a matter of time before valuations come down. We do, like John said, try to practice humility. We've learned humility throughout the years. We know that we can't time it. We don't know when it's going to happen. We know that mathematically it's bound to happen, though, from these sets of conditions. So the Fed is pretty much stuck. They're saying we might do this, we might do that. Overall, I don't think they're going to do anything. And, you know, gold being down $100 or so in a couple of days after the decision is a little bit disappointing. However, you know, gold still remains in a zone where we think it's very, very, very viable. A couple months ago, it bottomed in that 1680 range. And, you know, here is another opportunity to add a little bit if you don't have it or feel like you don't have enough.
Thanks. I'm glad you said that last point there, Mike. It is funny. We have this long-standing gallows humor that we engage in, that whenever the Fed opens its mouth, it's basically bullish for everything, but bearish for gold. And I think that partially that's because gold is the mirror of truth, that if left unchecked, you know, accurately reflects the decline in purchasing power of the US dollar. So it's something that the Fed really doesn't want to have, you know, sort of just, you know, in a runaway scenario, because it then sort of really shows the world how badly the Fed is killing the purchasing power of our currency through all of its policy efforts. But yeah, it's important to underscore that none of the fundamentals behind owning the precious metals changed after, you know, what Jerome Powell said last week. And he really did not say that much. He didn't change policy at all. The Fed is still going to be pumping just as much stimulus into the economy month after month. And even those dot plots that you mentioned there, Mike, I mean, they changed very, very little. And it's 2 years away. And it's just showing sort of the current, you know, probability of what the different folks who are on the Fed voting council there think might happen, right? So there's so many things that could happen between now and then, but, you know, bottom line, Fed hasn't changed anything, and yet the precious metals, you know, had a big downward reaction. And I think, to your point, Mike, it's an overreaction, or it certainly looks like an overreaction. And if you were looking at gold at $1,900 an ounce and silver getting up close to $29 an ounce, and wishing that you could have bought in at lower prices, well, you know, that's what dollar cost averaging is all about. And this may be a really good opportunity to get in at more attractive valuations. And if you haven't sort of begun building your stack yet, well, you just got a gift here. So, all right, Mike, let me go to you. Sorry, John, let me go to you really quickly on the dollar. Right before we started recording here, we were looking at a chart of the dollar, which has sort of been in a downtrend for the past year, maybe kind of bottoming out over the past couple of months. It's beginning, probably too early to call a trend here, but it's beginning to show some signs of life, heading back up to its 50-day moving average. Just curious if that's something that you guys are keeping your eye on, because obviously a strengthening dollar here would surprise an awful lot of people on Wall Street, and you know, could have some inverse impacts on stocks and commodities, et cetera.
Yeah, we do look at that. We look at, you know, probably more data than we should, frankly, sometimes, but we monitor everything. Yeah, the dollar over the last year has been pretty weak, but if you look over the last you know, several months, since about August of last year, I guess, it looks like we're kind of basing out in kind of a trading channel. We speak of the dollar in terms of the dollar index, which is a basket of currencies, you know, the dollar relative to a basket of other currencies. And that dollar index, for example, has been trading roughly between 89 to 94, 95. So, you know, back in August of last year, we were right around the 95 level. That pulled back to, you know, early this year, about the 89 level. Then we had a spike in the dollar up through about April to about the 92.3 level. And then precipitously declined over the next couple months. until just the last handful of days, frankly. Recent dollar strength has just been over the last handful of days, and most notably the 2 days following the Fed meeting. A couple days certainly does not make a trend. It's a very knee-jerk reaction to what I think we can now look back and say was kind of a lot of hot air, not a real lot of things in that Fed meeting other than words and suggestions rather than real meat. So it remains to be seen. Would not be surprised to see the dollar maybe continue near-term strength, but again, the real test is whether it can break through that 94, 95 level and see longer strength beyond that. And we just got to wait and see.
Okay, and we'll be monitoring it here. We'll check in on this again next week and see where it is for folks. One of the things I bring it up, one of the reasons why I bring it up is it would be a big surprise if we all of a sudden suddenly had a surge in the dollar strength from here. So many people on Wall Street are over on the other side of the boat, betting on continued weakness. And I do just want to point out, last week on this channel, we ran the video of David Hunter from the Wealthion conference earlier in June. And he had said that he sees that dollar going down further, perhaps as low as 80 during this sort of last, gargantuan melt up that he's predicting. Before then, he thinks the massive market correction is going to happen. Is David right? Who knows? We're going to be checking his crystal ball predictions with reality as we go forth in the next couple of weeks. But if the dollar strengthened from here, that would definitely be against his prediction. So again, I wanted to bring it up here because that could be a real, I won't call it a black swan. It's not that unexpected, but it really just could be a big negative surprise for the markets. All right, Mike, as we begin to wrap up here, I do want to let you have the last word here. You were mentioning before we hopped on camera here that something that's catching your eyes is a lot of potential unwinding of a lot of speculative trades, which could potentially be a harbinger of air coming out of a lot of these asset bubbles, and of course, if it does, there's a lot of room downwards from here. So, what are you looking at specifically?
Well, look, this has been an interminable bubble in the stock market. It feels like it's gone on forever, and it has. It's certainly the largest run, a bull market run, basically in history, as measured by a lot of different ways. However, where our concern is that the data, when I mention data, I mean valuation. It primarily has never been more extreme, and complacency has really been pretty extreme as well. And we look at things like dispersion amongst markets, and just noticing a lot of dispersion. We're still seeing a lot of speculation in some of the meme stocks like AMC and GameStop, that type of thing. But I just made some notes here. The Dow Jones topped on May 10th, almost a month and a half ago. The S&P hit a new high on June 15th. Now, I said the Dow topped. I should say so far, the top so far. I'm not calling it absolute top, although it would not surprise me if the absolute top on the Dow Jones was May 10th. So a month and a half has gone by. The rest of the market's kind of grinding along sideways. The S&P went a little higher. It hit its relative high just a few days ago. And then the NASDAQ just recently hit another high, just here a couple days after the Fed announcement. Gold went down, tech stocks went up. Apparently that's what the market prices in when, with the potential rate increase. But there's other things that are very speculative too, like lumber. Lumber is down almost 50% in the last month, about 47%. Wheat, soybeans, corn, the whole agricultural complex is down hard. Some of the base metals like aluminum, copper, zinc are down pretty hard. So while we're big believers in commodities and hard assets for the long term, some of the near term kind of inflation worry and just runaway commodity boom has also rolled over, and no one's really noticing yet. Not to mention Bitcoin, which went down 50% from its high pretty quickly about a month or so ago, and it still remains down 40-something% from its high. So all while we're seeing new highs in the stock market, particularly the NASDAQ now. One last word about the NASDAQ, those highs are happening on fewer and fewer components. The breadth and the participation in the index is lagging. So it doesn't mean anything really immediately, but the market's not as strong as you think. That's all. And we're just noticing some dispersion.
I think that's great context, Mike. And, everybody who's watching this video, I think is trying to figure out, all right, where is the puck headed from here? And we've had a lot of guest experts on this program of late who, it's not unanimous, but I would say definitely the overwhelming consensus is that these elevated market valuations are not going to be able to sustain. And at some point, there's going to be a correction in the markets, and a lot of them are predicting a very painful correction in the markets. And sort of as precursors to a drop like that is we would expect to see the highest flyers, the assets with the most distortion, cooling off first, right? Because that's where gravity is going to pull hardest first, is on those high flyers. So who knows? You just went through a list there. Definitely caught my attention. And so, it'll be interesting. So we've got people like David Hunter, I mentioned earlier, who think, believe it or not, it's going to get even crazier before that correction hits. But as we always say, nobody knows the future exactly. Nobody has a crystal ball. We're all talking probabilities here. So we will continue tracking all of these data points each week on this program, so that our viewers, can hear our real-time best assessments of where we think we are in the story. So with that being said, folks, well, let me put it this way, Mike and John, is it fair to say, in going back to Grant and Stephanie, that their sort of general combined prediction of at some point in the relatively near future, could be months, could be a year or two, there's going to be a big deflationary crunch where prices are going to contract. Then the central planners are going to respond in a way that is just going to dwarf all efforts that they've made today, and that's where real sort of runaway inflation, real asset price bubbles is going to happen in a way that makes what we've seen before look like child's play. I see you guys nodding. Do you guys sort of share that general view?
The only kind of context I'd put in that, Adam, is that we're already in a very massive bubble, and stocks, for example, and we've said it many, many times, we'll make the point again, it's almost irrelevant if we are in deflation or inflation, because both periods usually stink for stocks when they're hyper overvalued like they are right now. So it almost doesn't matter to most people at home that maybe are sitting on a heavy stock allocation, because it's almost like we're almost in a perfect storm for all of it to be bad. And that's simply because we are so outlandishly valued, and it's pervasive. John Hussman does some great work. He breaks the market down into deciles. Every decile is more overvalued than it's ever been in its own history. All
right, great. Well, that was a perfect answer, John, because where I was going with this is for viewers that watch the interview with Grant and Stephanie, agree with them and want to take action based off of that. As Grant said, this is now the era where active investing is much, much more important, right? If you just buy the index and sit there long, you're going to get destroyed if indeed this correction happens. So you need to make sure that you are deploying your portfolio in a way that is strategic to the outcome that you see coming. And of course, as we always do, we recommend you work with a good professional advisor to do that, one who understands all of the risks that Grant and Stephanie were mentioning. As I say every week, if you've already got one, fantastic, stick with them. But if you don't, you should really consider talking to Mike, John, and the team at New Harbor, because they offer these free, no strings attached consultations where they'll sit down with you, they'll go through your entire financial situation, and they will give you their direct advice. And there's absolutely no pressure to work with them. It's completely free. And they do this as a public service because they are so concerned about the magnitude of what might happen that they want to try to get as many people prudently positioned beforehand if possible. All right. Well, folks, thanks for watching. Guys, it's been another great week. If you enjoy seeing great interviews with phenomenal minds like Grant and Stephanie, do us a favor, please subscribe to this channel by clicking the subscribe button below, as well as the little bell icon right next to it. Because I'll tell you, folks, the more big names like them we get on the program, the easier it is for me to go out and get even more big names to come on for an interview. If you want to see who's coming on in the future, we've got some great guests. Follow me on Twitter at Menlo Bear. I'd love to hear your suggestions on who else you'd like to see on the program as well. And with that, John and Mike, Thanks for another great week, guys. I'll see you next week.
Thank you, Adam. We'll see you soon.
Thank you, Adam. Take care. See you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.